Hi, good morning, everyone. Thanks for joining us for our morning call. So we have quite a few stock counter updates, and as well as the FAANGM Monthly and the usual Singapore Weekly. Do note that next week on 2nd May, there will be no webinar as it's a public holiday. It will be resuming as per normal the following week. So without further ado, I'll hand it over to Tim.
Yeah, thanks, Glenn. Jonathan is unable to present today, so I'll just be taking over his presentation. So we'll just be going through Netflix first quarter 22 results. The title is Shifting Efforts into Higher Monetization, because they'll be raising prices rather than subscribers for growth. So with regards to the results are in line with our expectations. First quarter 22 revenue and PATMI came in at 24 and 29% of our FY22 forecast respectively. But the key negative is the paid memberships declined. So, but if you look at the positives first, on the top right hand corner, you can see that the EPS beat the company's guidance by 23%. This is mainly due to the price increases they did to their subscription plans. We'll talk about that later. But simply just by adding $1 for their basic plan, so they increased it from, I think they increased it just by $1 for the basic plan, and it all went down to the bottom line, and this caused the EPS to beat the guidance by 23% already. So that was a big positive for them. But for the negatives, if you look at the chart on the top left hand corner, if you look at the net additions row, you can see that paid memberships missed their guidance by a wide margin. So they actually lost 200,000 subscribers quarter on quarter versus the guidance of plus 2.5 million. So they actually guided for positive 2.5, but they lost 200K instead. The revenue is also slowing. It's only up 2% quarter on quarter and 10% year on year, and it's still declining. The growth is still slowing after the pandemic spike. So the key thing is the weak guidance also for membership growth for the next quarter. So they guided for even more subscription losses of negative 2 million subscriber loss in the next quarter. So that really was the big news that pulled down the stock price. So we'll move on to the outlook. Next slide, please. Okay, so for the outlook, the guidance is weak, as mentioned. The subscriber growth is no longer growing. It's losing now. But overall we're still positive on Netflix as a contrarian view. What they're trying to do is embark on a new monetization path. So the model now is to increase prices rather than to increase subscribers. So of course, if you increase prices, this will cause a churn, and it will cause you to lose subscribers. But we are still positive on Netflix because we think that the higher prices can drive the earnings despite the loss of subscribers, as we saw just now from the EPS beating by 23% just by increasing the price by $1. In addition to that, they're also amending their policies with regards to password sharing. So they will also be monetizing that aspect of the subscription base as well. So this will be the new key. This will be the key monetization path moving forward for Netflix. Is a change in model for them. But we think we're still positive on the stock based on despite the slowing subscriber growth. So we still maintain a buy. Target price is lower at $427, previously at $673. This is mainly due to the slowing growth and the lower subscriber base, but and the churn that is expected in the short term. But we are still bullish on the long term path of the stock. So we reduced our PATMI forecast by 2%, and we also lower our terminal growth rate due to the weaker overall growth outlook moving forward for the short to medium term. So, and also we adjusted the WACC from 9% to 11.5% and raised the beta. Okay, so that's all for Netflix. We'll move on to TDCX, which we just initiated on. We'll go through what TDCX does later shortly. But the title is called Proxy for High Growth New Economy Companies. Just to let you know, TDCX is listed on the NASDAQ, not on the STI. So they're a US listed company. And the reason for the title is because they're riding on the growth of new economy companies such as Facebook and Airbnb. So just some background on what TDCX does. So their main customers are the tech companies like Facebook, Google, and Airbnb. So they have a track record with all these big tech companies. So what they provide these big tech companies is essentially specialized customer services. So the number one thing, the biggest segment that they do is omni-channel CX solutions. CX stands for customer experience. So an example of this is for Facebook. So Facebook has this digital marketing aspect to it where people advertise on Facebook, but not a lot of their customers may not know how to do that, especially the new ones that are just starting out. So TDCX comes in with regards to educating customers on how to use Facebook marketing. So this is beyond basic inquiries. This is going deeper into education, teaching customers how to use the platform and this kind of things. Something that Facebook outsources to TDCX. And this is also true for Google digital advertising as well. The second segment that they do is sales and digital marketing. This one is quite basic. So they just develop digital ad campaigns for customers, for small and medium-sized businesses. So the digital ad campaigns will, for example, be on Google or Facebook. So they develop the campaigns for the businesses. And the last segment that they do is content moderation. This is the smaller segment. So an example of content moderation, for example, for their client Airbnb, if people want to list their properties on Airbnb so that people can come in and stay, TDCX will come in and vet those listings before they get posted. So to check whether the property is real, to see whether the details are correct and this kind of things. So that is an example of a content moderation. For Facebook also, TDCX will come in and vet posts before they go public, so that it doesn't so that posts that may be against regulations will not go public before they when certain people post them. So that is an example of content moderation for Facebook. So these are the three main segments for TDCX. Okay, next slide. So for the revenue breakdown for omnichannel customer experience, it's the biggest revenue contributor at 62.4%, followed by digital marketing at 20% and content moderation at 15%. Geography-wise, they are mainly in Southeast Asia. So although their clients are US companies, but they service the clients' businesses in Southeast Asia. So that makes up 91% of revenue. And so with regards to growth, revenue has been growing steadily at 28% year on year. A strong 28%, and also net profits double digits as well. Next slide. Okay, so for our investment thesis, the number one is growing existing client revenues, which is basically means that they're riding on the growth of their existing customers. So 90% of their revenue growth actually comes from existing customers such as Facebook, Airbnb, Google. And as these companies, the big tech companies, continue their growth, their customer experience, customer service needs also increases in line. And all these are outsourced to TDCX. Because they don't do it in-house, they don't have the capabilities nor the scale to, or they don't even have the focus with regards to this aspect of the business. So they outsource it all to TDCX. And So TDCX enjoys increasing contracts, increasing headcount, cross-border expansion, cross-selling services, all from these existing customers. So TDCX is riding on the growth of its existing big tech customers. So that's the first thing why we like TDCX. The second thing is that they are expanding into new verticals, tailwinds from expanding Southeast Asia customer service market, which basically means expanding into new products and regions, expanding into Southeast Asia. So the client count, they're going to expand it from, they're already expected to expand it from 38 to 52, mainly from Southeast Asia. And the new products they're going to service are fintech. The new industries are fintech, gaming, and food delivery, all the upcoming tech industries that all require a heavy customer service. And so outsourced customer services is expected to grow really strongly at 13% compounded annual growth rate as the tech companies in Southeast Asia expands and are unable to handle it themselves, whereas TDCX has the scale and capabilities of doing that. So yeah, the reason why is that they don't have the capabilities and the patience to take on the large scale hiring. So expanding into new products and regions will be a big structural growth for TDCX as well. Next slide, please. Okay, and our last thesis is with regards to stable cash generative and asset-light business model. So basically business model strength. You can see that their margins has been steady around 30 to 33%. If you look at the chart on the right-hand side, net margins also around 20%. So the margins are steady. And the PATMI growth, the profits after tax growth is growing at a very fast pace at 37%, in line with all the big tech company growth as they outsource all their customer experience to TDCX. So, and in addition to this, the business model strength, they are also leveraging on their strong balance sheet to start delivering returns to shareholders by through share buybacks. Okay, next slide, please. Okay, so with regards to risk, the key risks to monitor are the concentration risks. So they do have some geographical and revenue concentration risk. 91% comes from Southeast Asia. And with regards to revenues, the top 2 clients contribute 62% of revenue, and the top 5 clients contribute 84%. So these concentration risk is key for TDCX, although we think that customers should be quite sticky with regards to TDCX, because the data that TDCX handles is quite sensitive, and it's a bit hard. And it's a bit hard for the tech companies to move to other vendors. And the last key risk to look at is the rising wages, because this industry has been growing at a very fast pace. As demand rises for outsourced customer experiences, so will the wages, especially in the US and in India, and also in Philippines, which TDCX mentioned. So the higher labor costs may hit margins for TDCX, but we are quite confident that TDCX will be able to pass on these costs over to their clients, as you can evidently see it from their margins has been stable for the past few years. Okay, so we initiate a buy on TDCX with a target price of $22 based on the DCF valuation, WACC of 9.7% and a terminal growth rate of 3%. So that's all for TDCX. We will now move on to the FAANGM Monthly for the March performance of the FAANGs in March this year. So the FAANG stands for Facebook, Amazon, Apple, Netflix, Google, and Microsoft, the biggest tech companies in the world. So we just go through. The title is called Increasing Regulations. So most of the news in March was about regulatory headwinds. Sorry for the typo here. It's supposed to be March 2022. So the performance-wise for the FAANGs, it actually outperformed the S&P 500. So the FAANGs rose by 5.9%, but the S&P only 5.2%. So the market rebound was better for the FAANGs, the tech companies in particular. The outperformer was Facebook, gaining 9.3% after falling quite heavily after their earnings. But Netflix was still the underperformer, declining 3%. This was largely due to the continued negative impact from the earnings. So we'll just move on into the news itself. The next slide. Okay, so just update on Apple, Amazon, and Microsoft. What has happened in the month of March? For Apple, there were a few headwinds for them. So the first headwind was TSMC warned of slowing smartphone demand. TSMC is one of Apple's main supplier of semiconductor. So when the chairman comes out and says that growth is slowing because of the China slowdown and also because of component shortages, that may be a headwind with regards to Apple's next upcoming earnings this week on Thursday. And Apple also cut the production for their iPhone SE 3 by at least 20%, and this is because of lower than expected demand as well. So there's a bit of signs of softer demand for smartphones in general. Then there's also more worries on regulations. For Apple wise, the focus of the regulations is on their App Store. So for the App Store, Apple collects 30% of every dollar that is spent on the App Store, whether you purchase an app on the App Store or you spend within the app itself. Apple collects 30% of that, and many of the regulations are saying that that's monopolistic behavior. So they are targeting this business of Apple, which contributed about 15% of profit after tax in FY20 for Apple. So it's quite a big chunk of their profits. So this is this ongoing regulations is a lingering headwind for Apple. So the two key regulations that has been gaining traction is the Digital Markets Act, which affects Apple's business in the European Union, in Europe, and the American Innovation and Choice Online Act, which affects Apple in the US. So both in US and Europe are coming out with regulations targeting Apple App Store. So this will remain a headwind with regards to that business. And another news that came up for Apple was that they're planning a hardware subscription service. So instead of buying an iPhone, you can just subscribe to an iPhone. Basically, you don't own it, but you just subscribe to it. You pay a monthly fee, and this will help to boost its recurring income. This may be announced at the end of this year. So overall, for Apple, the headwinds are signs of softer demand and ongoing regulations. So it may keep Apple's share price in a consolidation in the near term. But we think that share buybacks will still continue to lend support to the share price. With regards to Amazon, there was only one key news in the month of March, which is unionization. So Amazon's largest fulfillment center in New York, called the Staten Island warehouse, successfully unionized in March. So because Amazon employs a lot of employees in their fulfillment centers for their e-commerce business to deliver a lot of goods. So this unionization may affect Amazon's cost expenses because the unions are calling for higher wages, better health coverage, and everything. But if you look at the impact of just this unionization, the impact is still rather small, estimated around $200 million US dollars, or 0.5% of the profit after tax for FY23. So the impact is still very small. The worry is that it spills over to the other warehouses that Amazon runs, but that is yet to happen at the moment. But the impact is still quite small. So what is the key theme for Amazon right now is expenses, lingering pressure from growing wages, and also fuel costs with regards to delivering what is goods. So we expect this to weigh on Amazon's upcoming earnings on Thursday also. And also there's the pandemic spike in e-commerce may also continue to slow down as well, and that may be another headwind for Amazon. we think Amazon is more of a second half 2022 play, because Amazon is beginning to pass on the higher cost to consumers through higher fulfillment fees. In the past, Amazon has always been having the rhetoric of being customer first, so they always absorb the cost for customers. But recently, they have been beginning to pass on the higher cost to customers. So this will definitely benefit their second half earnings. Okay, and for Microsoft, there wasn't any much news for Microsoft with regards to their earnings, which is coming out tomorrow on Tuesday. We think that earnings should remain strong with regards to their third quarter 22 results. The big trends for Microsoft is cybersecurity and also the reopening play for their Microsoft Office. So because of the Ukraine crisis, there's been a huge spike in cybersecurity attacks, and companies we expect companies to continue to upgrade to higher end licenses in Microsoft for better security in the cybersecurity space. That's is a big priority for for most companies. And the recovery and reopening in the US with regards to small and medium-sized businesses will also drive volumes for Microsoft productivity software, which has 90% market share globally. So we think these two tailwinds should drive earnings to remain strong for the third quarter results. Okay, next slide, please. Okay, so this is with regards to the last three FAANGs, Meta, Netflix, and Alphabet. So Meta, not much news. They're just building a 1 million square feet data center in Kansas City. So this will may increase the capex in the short term. For Netflix, they also announced price hikes in the UK and Ireland, so increasing by $1. So like we saw just now, it boosted margins and the EPS by quite a significant margin. So this is the new model that they're going for that will also cause a bit of churn in their subscriber base. And they're also cracking down on the password sharing. So a lot of people are using Netflix, sharing accounts with their own families, and many people are not paying for it. So what they're going to do is they're going to test ways of monetizing this password sharing moving forward. With regards to Google, not much. The big news, the first news is agreement to buy Rexium, which is their entry into the AR/VR space, and also Waymo, which is their autonomous driverless robo-taxi services. So they are fully launching their driverless taxi services. But the key news with regards to Alphabet is the Play Store, which is affected by regulations as well. So they're beginning to allow developers to offer alternative payments outside of the Play Store. So this is the same headwind, similar to what Apple is experiencing at the moment. So as developers offer alternative payments, then Google will not be able to collect the fees from whatever is spent onto in the Play Store. So there's a bit of headwind there. So next slide, please. So the outlook for the FAANGs, we are still overweight on the FAANGs, but we are taking a much more selective posture. Our preferred picks are Google and Microsoft, because the other stocks are more heavily affected by regulations and also some headwinds with regards to cost. So we expect Google to continue benefiting from digital advertising, which makes up about 90% of their profits, and which is 90% of their business model. Then for Microsoft, we expect a strong corporate demands for their higher end licenses from the push for cybersecurity capabilities, and also the reopening play. So Microsoft has we think that Microsoft has a higher earnings visibility moving forward with regards to its third quarter 22 earnings. So thanks for listening. So we'll just move on to Natalie. Thanks.
Thank you, Timothy. Good morning, everyone. I'll be talking about Keppel DC's first quarter 2022 business update. Okay, just starting off with the table on the left-hand side, we see that gross revenue actually fell by 0.9%. This is despite contributions from their recent acquisitions of Eindhoven campus, Guangdong DC, London DC, as well as the completion of IntelliCenter 3 in July of 2021. So all of these contributions were actually offset by provisions for litigation with a tenant called DXC, as well as depreciation of the euro against the Singapore dollar. Okay. So this depreciation of euro against Singapore dollar is largely accounting in nature, because Keppel DC actually hedges 100% of the income received in foreign currency. So while the gross revenue line will be impacted, further down under the P&L, there will be a line item that actually recognizes a gain in FX derivatives. So on a DPU, from a DPU perspective, there actually is no impact from this depreciation again of the euro against the Singapore dollar. Okay, net property income, it fell by 1.4%. This was due to higher property expenses, such as your electricity costs, as well as higher repair and maintenance at one of their data centers called Amsterdam DC. The distributable income rose by 5.9%. This was due to contributions from the investment in M1 bonds, or rather, it's actually called Netco bonds, but it's the M1 bonds. Yeah, and that resulted in a relatively flattish DPU growth of 0.2%. So this DPU of 2.466 cents, that formed about 25% of our FY22 forecast. Moving on to the positives. So the positives would be this 386 million in acquisitions that helped to offset or cushion the electricity costs and provision for litigation. So without that, I think we might actually see a decline in DPU. So there's a silver lining there. For portfolio occupancy, it was up by 0.4 percentage points year on year, and so from 98.3% to 98.7%, and this was largely due to improved occupancy at Dublin 1. It improved from 82.3% to 95.9%. In terms of negatives, the litigation against DXC, this was initiated by Keppel DC and is regarding revenue from co-location services provided at Keppel DC 1. So the sum in dispute under dispute is 14.8 million for a 4-year period that began last year, 1st of April 2021, all the way to 31st March 2025. So in terms of annual impact, 0.4% of NLA and 2% of FY21 DI. So that is the annual impact. Another negative would be an increase in the cost of borrowing from 1.6% to 1.8%, as well as a slight creeping up of gearing from 34.6% to 36.1% due to the acquisition of London DC. Okay. In terms of outlook, there are about 17.1% of leases due to expire in FY22, and these are likely coming from Keppel DC 4, which is a co-location asset located in Singapore, given the short WALE of 0.4 years. So we are fairly confident of renewal because of the high cost of relocation for data center operators. So, our data center tenants. So because of this high relocation cost, there's high tenant stickiness for Keppel DC, and so therefore we are fairly confident of renewal despite new supply coming online over the next 2 to 3 years. In terms of rising electricity costs, about 90% of energy costs are passed through, and more than 90%, are passed through to the tenant. And in terms of sensitivity analysis, Keppel DC has shared that 10% increase in tariffs from first quarter 2022 will impact DPU by 0.4%. Okay. So this is a little bit of a background here. The tariffs, Keppel DC hedges, there are some hedges in place for the data center, for electricity costs for 2022. But the part that is hedged is actually the bulk discount amount. So there are tariffs tariffs differ for households, wholesale, as well as bulk. So Keppel DCs will pay the bulk tariff. That means it's the really the lowest tariff because of bulk purchase rates. And then on top of that, they are able to get bulk purchase discount on that rate. So the one that is locked in is the percentage discount. And then for the tariffs, it will fluctuate quarter to quarter. So if let's say from moving from 1Q to 2Q, the 2Q rate, there might be a fluctuation in this tariff rate. Yeah. So a 10% increase in this tariff rate will impact DPU by about 0.4%. And I just want to share a little bit more. So for the first quarter of 2022, year on year, that means since 1Q 2021 all the way until 1Q 2022, the tariffs have increased by about 27%, and that has resulted in a 2% decline in DPU. So this time round, in terms of forward guidance, it is the sensitivity and analysis is lower, or rather the DPU impact is lower. And this is because as Keppel DC renews some of the leases with their tenants, they are able to pass through a little bit more of this electricity cost. So that means there's less leakage in a sense. And also another way of looking at this is that since last year, the tariff discount has already fallen off, meaning that it is less compared to last year. So the discount is actually very, very small compared to what the market rate is. So there's very little more downside to this tariff discount. Yeah. Okay. Overall, our FY22 to 26 DPUs have been lowered by 3.7 to 6.1%. This is to factor in the provision for litigation as well as the higher electricity cost. And our DDM-based target price was lowered from 2.81 to 2.58. Yeah. Okay, so that's all for Keppel DC. Moving forward to Mapletree Commercial Trust. So this is a Phillip on the ground, and do note that we do not have any coverage for MCT. Next slide, thank you. Just starting off with the performance. So this is for their full year results ended March of 2022. In terms of gross revenue grew by 4.3%. This was due to higher revenue from all properties, due to higher occupancy costs as well as higher car park income, absence of rebates. Okay. In terms of MPI, MPI grew by a smaller amount compared to gross revenue, so it grew by 3.1%. This was due to absence of property tax rebate as well as wage support from the job support scheme received in last year. Overall, DPU before the release of retained cash grew by about 4.7%, and there was about 15.7 million in retained cash that was retained, at the start of two years ago, for buffer that was released this year. So 15.7 million. Now moving on to the positives. The positive will be an improvement in occupancy. So occupancy was up from 92.5% to 94%. And if you look at committed occupancy, means occupancy that has already been signed on or leases, signed but has not yet begun. That occupancy is actually 97%. The MCT also recorded positive reversions for their portfolio at 1.9%, and both the retail and the business or office segments were registered positive reversions as well. 2.1% for the retail and 1.7% for the office and business parks. Tenant sales at Vivo for 4Q also recovered to 2019 levels. So this 4Q period is referring to January to March 2022. Yeah, it's already back at pre-pandemic levels. In terms of the negatives, there's still some backfilling required for M Tower. So the committed occupancy for this asset is currently 88%, and the large part of the vacancies is really related to a pre-termination in the first quarter of 2021. Yeah. So there was some compensation for this pre-termination, which provides Mapletree with about slightly more than a year of rent, so that they have some time to do the backfilling. Yeah. Overall, the relaxation of border restrictions, and of course, in general, all the safe measurement, the safe measure relaxation that will help to lift tenant sales at VivoCity. And pre-COVID, tourist footfall actually accounts for 20 to 30% of VivoCity footfall. So of course that will help with the returning tourists as well as the increase in group size. We're also seeing positive leasing momentum for the office and business parks. So as the CBD occupancy or vacancy rate declines, then some of the fringe business parks and fringe office assets will also benefit from this spillover demand. Just as a reminder, the EGM for the MPAC merger, which is the merger between MCT as well as MNEC, it will happen likely in the end of May, with the merger completion likely happening in the end of August. Okay. So that's all for me. I'll now like to hand the time over to Glenn.
Thanks, Nat. So for me, I'll be doing the Place Holdings Limited. It's a Phillip on the ground, and we have no coverage on this counter. Okay, so for the Place Holdings Limited, just some brief background on what the company does. It's listed on the main board. It has a market cap of 570 million. So it has a primary focus on integrating traditional businesses and new growth opportunities in the digital economy. So just a quick update on their FY21 results. They posted revenue of 1.18 million, which is up 4% year on year. However, they recorded a net loss of 2.67 million, and this was mainly due to increased expenses. So what do they do? So they have three segments to their businesses. So the first one would be their property development and property management. So they acquired a freehold residential and commercial development at Tanjong Pagar for 148 million in April 2019. And the second property is a 20% equity stake in a mixed residential and retail development next to Tanah Merah MRT in January 2021. So for the second segment, it's their cultural tourism. They currently have a property site at the Mount Yuntai Scenic Area, and this is a UNESCO Global Geopark. However, the project was temporarily halted due to market conditions, but they have mentioned that this is minimal impact to their financials as they have no borrowings on this site. So thirdly, their third segment would be their media-related businesses. Firstly, they signed a MOU to acquire 51% of the IP rights associated with the property landmark The Place. So just to give a background on what The Place is, so the company is actually backed by the key management team of The Place Investment Group. This is a multi-billion PLC conglomerate, and it has strong track record in tourism, media, property management. And one of their key projects would be called The Place, and this is located in the Beijing CBD area. And it integrates Asia's largest LED sky screen. So if you can look at the pictures on the right here, this is what the sky screen looks like in Beijing, in The Place. So they have acquired the 51% of the IP rights for this property landmark, The Place, and as well as certain assets and businesses relating to the Shimao Tianjie sky screen located next to The Place. So this is what the sky screen looks like. And both of them are income generative businesses. So secondly, for their media-related businesses, they have collaborated with SMRT's business arm to jointly build Singapore's first sky screen. So it will be something similar to what they have at the Shimao Tianjie sky screen. And it's basically just a suspended video screen, and it's quite big. You can show a lot of media as well as images and video. So that's all I have for The Place. I'll hand it over now to Vivian.
Thanks, Glenn, and good morning, everyone. So this will be a Phillip on the ground for Nanofilm's first Q22 business update, and we do not have coverage on the counter. So next slide, please. For Nanofilm, they have three main business units. If you refer to the chart on the top right, the main revenue contributor would be Advanced Materials BU or AMBU, under which they do vacuum coating and they deposit these materials on key components and parts, including the 3C logos on your 3C products, wearables and accessories. This is under, so the 3C segment alone contributes about 63% of first Q22 revenue. And then there is also the growing automotive segment under AMBU. Secondly, we will have the Industrial Equipment BU or IEBU, which contributes around 14%. And lastly, nanofabrication, driven by the optical lens and sensors, and this contributes 6%. So on the first Q22 numbers, they only shared that revenue was up 27% year on year. But I guess the main concern would be that this increase could be contributed also by spillover effects, meaning that they were fulfilling orders which were not completed in 4Q21. And at the same time, margins remain stable. So on the Shanghai lockdowns, the situation there remains fluid, but fortunately, Nanofilm has managed to continue their production activities as they operate in a closed loop system with their staff working and staying in the factory. And this could be similar to what you see in the news that Tesla is doing for their Shanghai plant. So zooming into the different segments. So for AMBU, we see continued growth in the 3C segment, as mentioned, mainly driven by this communications and wearables and accessories. Management did mention that the typical peak season is in the second half, so expecting stronger growth in the second half of the year. And the long-term trend for this segment would be the growth from the automotive segment, which, as can be seen, the industry is growing rapidly, powered by adoption of EVs. So the company is also seeing positive developments for new applications in this segment, including fuel injection systems, battery connectors, and also other car parts. For the NanoFab BU, the growth is led by mass production products, including a few products that went into mass production the last quarter. And that includes this micro lens array or MLA project for new generation wearable sensors, and also this other lens project. And similarly, there is also a strong pipeline of projects for sensory components and lens. And lastly, Industrial Equipment BU, we see that the growth was due to equipment sales projects. And there is also a strong pipeline of projects, including developing coating equipment with new designs for solar energy industry. So in conclusion, for AMBU would be the growth of the 3C segment and also automotive segment in the long term. For NanoFab would be products that went into mass production. And lastly, for industrial equipment would be developing new equipment for the renewable energy industry. So that's all for Nanofilm. I'll now be moving on to a Phillip on the ground for LHN Logistics IPO. We covered the parent company LHN. So moving on to the next slide. So LHN Logistics is issuing, this is a spin-off. So LHN Logistics is issuing 167.7 million shares, including 25.2 million placement shares at 20 cents per share to raise gross proceeds of 5 million Sing dollars. So there is no public tranche, and the post-IPO market cap will be 33.5 million Sing dollars. So 89% of the funds will go towards partial financing of the construction of their new ISO tank depot at 7 Gao Avenue. This is one of the main growth drivers moving forward. And the remaining to the expansion of the transportation fleet and also acquisition of moving equipment. So the placement will close this Wednesday and trading will commence this Friday at 9 a.m. On the valuations, if we look at FY21 PE, the indicative PE ratio is 10.1 times. This is slightly lower than the other listed peers, logistics peers on the SGX. And for the dividend policy, the company intends to recommend and distribute dividends of not less than 40% of profits for the next 3 financial years. So next slide, please. Okay, zooming into the two segments. Firstly, on the leftmost part, we have transportation, and in the middle, we have container depot services. So under transportation, they provide services of collecting and cleaning ISO tanks, which are designed to use to be able to transport chemicals from manufacturing plants, for example, on Jurong Island to PSA to be exported. And they also provide cross-border services whereby they transport the chemicals from Malaysia to Singapore, and only Malaysia-registered vehicles are able to transport the chemicals. So under container depot services, as you can see, the workflow involves receiving the empty containers. So they will do the assessment, washing, repair, if necessary, maintenance, storage, then release for usage again. On the rightmost part, this is one of the main growth drivers, which is the new 7 Gao Avenue ISO tank depot to store and load dangerous chemicals prior to export via PSA. And other than that, if you compare to the current services that you provide under transportation, they would also be providing washing and storage services. So they are able to enjoy this first mover advantage by integrating these 3 main necessary services that any ISO tank needs: transportation, washing, and storage, all in one location and under one company, because now customers have to go to different companies for these 3 services. So moving on to the next slide, this is on their revenue segmentation. Transportation segment makes up about 66% of FY21 revenue. This has been quite constant over the last 3 financial years, while EBITDA recorded stable growth. And moving on to the next slide. So this is a bit more details on the segments and also key highlights. So under container depot services, they currently operate 4 container depots, 2 each in Singapore and Thailand, and total capacity is currently at about 27,000 TEUs. So for the key highlights, first growth driver, as mentioned, is the construction of this new ISO tank depot at 7 Gao Avenue, which would provide an integration of services for ISO tank. The second growth driver is the expansion in container depot and recovery in capacity. So the company is currently undertaking preparatory works to establish an additional overseas container depot in Myanmar, which capacity would be about 6,000 TEUs, and that marks an increase of 22%. And the management also mentioned that even though so for this container depot, it's not to be considered together with the coup, because even with the coup going on, for Myanmar as a country, the container depots are still functioning as per normal. So for the container depots in Thailand, rebound in global economic activity is expected to push the utilization rates up. And lastly, the indicative dividend yield of 4% looks attractive based on the FY21 earnings per share of 1.98 Singapore cents and the recommended dividend payout ratio of 40%. So that's all for LHN Logistics IPO. I'll now be passing the time on to Paul for Singapore Weekly.
Thanks, Vivian. Next slide. We'll just run through some key macro highlights for Singapore. Firstly, there are a lot of news on property. So if you look at the March number, property sales for new launches was down 50%. For the first quarter, it is down almost 50, also close to 50%. Sorry, for when you combine new launch and resale, just to measure how this will impact the real estate agents, total units in first quarter was also down 35 compared to 13%. So you can expect weakness for the real estate agents' earnings for first quarter 22. Because if you combine both, total transactions is probably down about 35. Probably only HDB is probably flat year on year. There was some news from hospitality, although it's still early, but it's all very good news. I think the RevPAR, you can think of RevPAR as just as like revenue for the hotels. So it's up 62%. It's only like 30% below pre-pandemic. There's a sharp rebound, and what we see is a lot of the rebound is in room rates. So in a way, we could actually see the RevPAR may even exceed pre-pandemic levels, because it's just, in a way there's limited supply. I guess the last 2 years or even 3 years, there's no new supply in hotels. So the rebound, who knows, but could actually be even better than the pre-pandemic levels, or at least temporarily. Just an update on passenger traffic from Changi is up 5 times, but that is still like 80% below pre-pandemic. In the US, the main news was Powell's commentary that it is appropriate for the Fed to move quicker. So it's almost a done deal that in the May, I think 6th of May, I think if I'm not mistaken, there will be, when the Fed meets, there will be at least a 50 basis point hike. The market is now, because there were some comments by other Fed officials that may not, even more than 50 is also possible. So the one timeline is maybe in May they'll raise 50, then June they'll raise another 50. So that's probably the base case now. We'll discuss all this later, some of these corporate developments. So technically, I think the interest rate cycle, it will still continue to rise. I think until we see some evident signs of inflation peaking, it's probably going to be premature to call an end to interest rates climbing. So you see a lot of commentary by a lot of fixed income strategists that maybe the 10-year bond yields might have peaked, but it's going to be a really difficult call to make until you see some signs of inflation peaking or even growth slowing down. So, I mean, this is going to be the most aggressive tightening because the last time the Fed raised 50 basis points, I think was in 2000, I think. In terms of the tech meltdown, there's some comments. We think that the weakness in tech might linger on for the near term. Just that the environment right now is that there's no long-term bets. I think no one's going to take a 5-year view, especially for those unprofitable tech companies, like Arc Innovation and so forth, if they don't even know what's going to happen the next 12 months. So that's why we see this continued weakness. And so long as people are unclear directionally where the economy is heading, I think no one's going to bet heavily or take a big long-term view on tech because you're not even clear what's the near term. For this week, there's going to be a lot of the big tech are going to release a lot of the results. You can see from the numbers there, Alphabet, Microsoft. Then on Friday, all the 3 banks will be releasing their results. So it's going to be very results heavy for this week. Some of the events you can see, we will have Keppel, Sonic, and iVal. iVal is the new IPO. Sonic is the one we wrote a non-rated, which is a net cash company, probably one of the rare ones that's trading at net cash. Sorry, I think below net cash. Next slide. So we showed this chart before, but I guess one of the market commentary now is if you focus on the red line, I think the market is a bit worried that the only way to stop such a sharp rise in inflation is if we go into a recession. So those beige columns you see is recession. So some of the commentary that we're getting from the market is that are we going to only stop this sharp spike in inflation, which is the red line, only when you get recession? So you see, of course, not all the time, but some of the sharp spikes you can see in 1970s or even 80s or mid 70s that you can only stop it when you get a recession. So hopefully it doesn't happen, but that is one of the worries. Yeah, next slide. So this is just a quick snapshot. Because the URA released some of the residential property stats. I guess the only comment we can say is that the inventory, which is the blue bar, the unsold homes, is still very low. You're talking about 14,000. So this is one of the lowest, I think more than a decade. You can see from the bar chart here. So this should keep property prices elevated, and it will be, in a way, I guess, positive for some developers, even though transactions is not there. But if you look at the red line, which is the inventory to sales, I took the last 12 months, even if you take the very weak number of the last quarter, you're still talking about maybe 2 years or 2.5 years kind of, sorry, not 2.5, less than 1.5 years of inventory, which is below the average, which is 2.7 or 3 years. So we are going into this cycle with very little inventory, which should be beneficial for those developers that still have inventory, I guess. Next slide. So for this slide, what we did was this blue line is basically the transaction volumes, which is new launch and also resale, just to have a sense of because it's going to affect the real estate agents because they rely on just transactions, which is new launch and also resale. So this blue line is basically the 12-month moving average. So you can see that we might, the last time, if you look at the orange arrow, the last time we had property cooling measures in June, early July 2018. It took us 12 months, which is only natural because you are talking about a new level. So we think that the transactions for this year is going to just keep sliding. Any stability will only happen in 2023. So you can expect at least maybe 4 quarters of weak results coming up from the real estate agents. I mean, this is just how we are preparing ourselves. At least directionally, this is what we think is going to happen. Next slide. So because of the reopening, again, just a flash of all the reopening stocks compared to the pre-pandemic, which is 31st December, and then the latest price on Friday. This is just for everyone to take note. I mean, depending on which sector you want to play, but these are the ones that should be benefiting from reopening, and these were their prices compared to pre-pandemic. Next slide. Okay, this is a quick update on the Phillip on the ground Keppel REIT. So Keppel REIT did a briefing for the first quarter. I think just 2 highlights for me, maybe 3. The first thing is the rental reversions was very strong, was up 8%. What they said is there's limited office supply, and because of the high occupancy, they can command higher prices. And now the signing rents now is $11 to $12 compared to the expiring about $10. So this year should see a big uplift in rental reversions because the last signing, which was 3 years ago, was about around $10. So now it's 11 to 12. Electricity, for the Australian assets, very limited impact, but for their buildings in Singapore, most of them have long-term contracts, so they will start to expire in end 22. So this year no impact, then maybe next year will be a little marginal, some small impact. I think, okay, the final thing just want to highlight is that in terms of acquisitions, they keep on mentioning that the biggest hurdle is the volatile interest rates and need to be careful. So this could be a theme, I'm not sure because Natalie knows better, but this could be a theme for acquisitions because if your spread, that means your carry between the rental yield versus interest rate is quite thin, and you know interest rates can move at least 200 basis points. So a lot of them are a bit hesitant to make any acquisitions because you might be buying a negative carry acquisition. That means your interest rate is more than your rental yield. I mean, most of us, when you want to rent out, we want to make sure at least the yield is higher than rent interest expense. So what they might be suggesting is that because rates are climbing so fast, they're just a bit hesitant to make any acquisitions. Next slide. Okay, this is update because we got so many questions on Yang Zhejiang restructuring. So we have 2 slides on this. So the first slide is just a reminder that the old Yang Zhejiang has split into Yang Zhejiang Shipbuilding, the table on the chart on the left, sorry, the picture on the left, and Yang Zhejiang Financial. So Yang Zhejiang Shipbuilding is the usual building of container ships, bulk ships. The other part is, we like to call it a hedge fund because they invest in private equity, they lend money, they have fee income, they also take investment, they also take stakes into all these investments. The listing is on the 28th of April. Next slide. So all the shareholders will get 1 for 1. So in terms of the valuations, again, these are purely our own estimates. We don't have any model on this. We're just taking the historical number. So if you look at the NAV, the 3.3 billion, 4.2. So this is from historical numbers we took from their annual report. And if you look at the price to book, this was yesterday. So if you look at Yang Zhejiang, the shipyard, right now, that was yesterday's price, Friday, 965. So they're trading at 1.1 times book. So the thing right now is when the Yang Zhejiang Financial gets listed, what is the fair value? Again, we are just taking a guess. This is a purely guesstimate. We use 0.6 if you look at the price to book, 0.6, because number one, like we highlighted before, the Chinese banks are trading at 0.5 and they pay 7% dividend yield. So the question is, how much more should I pay for this? And number 2, how much you should pay? There's a briefing tomorrow, so we don't have the details. It will all depend on the quality of Yang Zhejiang Financial's earnings. If the earnings, a lot of it is fee income, interest income, then okay, then maybe we are more willing to pay. I mean, we don't have clarity on that. But until we know how much is that, we are not clear how much of the income actually comes from mark-to-market gains. So we're just pegging a 0.6 times PE, and this is what we get, 65 cents. Of course, number 3, the third point is some might value this on PE, but we're a bit hesitant. Even the banks, we don't dare to value on PE because it's too volatile. So we think, I mean, our own view, price to book is the best, and unless you show evidence that your income is very stable throughout the cycle. If your earnings swing up and down, then nobody uses PE as it's almost like a joke. So that's why you should use price to book, and that's the valuation we get. The other implication is, if you look on the right, is that according to the rules, so Yang Zhejiang will be included, is eligible to be included in the STI. So once they're included, somebody has to get kicked out because the STI is only 30. So according to the rules, if you look at the bottom, if a constituent company, which is Yang Zhejiang, is split into two, so provided they are larger than the smallest constituent and they're looking at full market cap, so what is at risk is actually ComfortDelGro. So if on the 28th, I think that's when they do the computation. If Yang Zhejiang Financial is bigger, the market cap is larger than ComfortDelGro, then there's a risk that ComfortDelGro will be removed and Yang Zhejiang Financial will be included. Again, depends on the opening price. I think if it opens at 80 cents, then maybe then the market cap will be larger. So this is the other implication. The chart on the bottom, you see this dairy farm. Initially, we thought that based on the smallest weight, because dairy farms weight on the STI is only 0.4, it's the smallest. So we actually thought they would be at risk, but when we read the rules, they said full market cap. So I mean, I'm not sure if, hopefully that's right, but again, we're not the STI, no one gave us a briefing. This is based on our own readings. So we think Comfort will be at risk, and if the market cap of Yang Zhejiang Financial is larger. Okay, this is what we just wanted to point out to everyone. Next slide. I think this is the last one. Okay, sorry. This is the ultra last one. Just that another interesting development has been the last 1 month or so. There's been a lot of M&As in the healthcare sector. The biggest one announced was Ramsay. I hope I'm pronouncing right, but anyway, Ramsay Healthcare in Australia by KKR. So they are valuing, they got, I think, 72 hospitals. So this is a huge entity. But if you look at the valuations, they are buying this at 5 times book and 51 times PE. Another one was IHH also buying Ramsay's hospital. So what we're just trying to say is that hospitals, if there is a M&A, their valuations can be extreme. So Raffles Medical is trading at 2 times PE. Where the last few takeovers was like 5 times, 2 times price to book, sorry, not PE. And if you look at, so it looks cheap, I mean, Raffles Medical compared to all these assets that were taken out. Again, our valuation is still a whole, because we're not pricing any GO valuation, but we just wanted to highlight that if they ever decide to sell, they can get very good valuations, like almost 5 times price to book. Sorry, someone asked to slide the recovery place. Oh, sorry, can you all flash back to the recovery place? Okay, yeah, this slide, yeah, just leave it on for 1 minute. Okay, we are going to end it with a poll. We need to trouble everyone because we do conduct listed company webinars, and it's usually live, and the listed want to have it recorded. So we're not sure the timing because most people are not already not working from home. So we're going to come out with a poll to ask everyone, is it better to have it at 12 o'clock, 3 o'clock, or whatsoever? So do bear with us if you have time to do the poll. In the meantime, I think we can go on with the Q&A. Yeah, I think Natalie, maybe you want to go first. Yeah, this poll is just to give us the best, what's the best timing to do a ListCo webinar, because we're not very sure, since most people are already in office, I guess. Yeah. Thank you everyone for your participation. Natalie, you want to go ahead?
Oh, sorry, my camera. Okay, yeah, better. Hi. Hi. First question. If Keppel DC's FY22 to 26 DPU is expected to be lower by 3 to 7%, 3.7 to 6.1%, why would you still consider it a buy since there's alternatives like DCRU? So the reason why Keppel DC is still a buy is because there's still some upside to the target price, meaning plus your dividends and everything all in, there's about 28% upside. Yeah, because currently the share price is about 208, and our target price is 258. So it's a 50 cents upside plus also the entry price is actually quite attractive. FY22 DPU yield is about 4.7%. So with regard to other alternatives like DCRU, we don't actually have coverage for DCRU, and based on what we understand, yeah. And so I think for DCRU, their dividend yield is about 4.9%. Yeah. So it's pretty much similar, but we do not have a target price for DCRU. Yeah. Okay. Next question is, would higher electricity costs going forward negatively reduce the DPU of other REITs and data centers?
Is Natalie stalling or is it mine?
Yeah, I think she hang.
Okay. Can you let her know? We will just continue with the rest. Yeah. So sorry for that, everyone. Let me just read up the next question. I think because it's probably raining. Okay. Paul, what's your views on the ban of palm oil from Indonesia effective from 28 April? Yeah. Okay. We think the benefit number one, the beneficial. So just for everyone's benefit, there has been a ban by Indonesian president on the export of cooking oil and related. That means ban or everything. So the implications, of course, number one is going to be, and as a result, palm oil price I think today maybe up 8%. So the implication is, of course, the Malaysian ones will benefit. But at the same time, and of course, Golden Agri, all this will be negative. But we think, my own thoughts are that, although we don't cover, it's probably an opportunity if Golden Agri and so forth drop more significantly. Because what it also means is that they definitely have to lift back this ban. They cannot continue with the ban for too long. Just like the coal ban, they imposed it and then later on the ban was lifted. So the reason why they made this ban was because I think Ramadan is coming and then there's like a shortage, I think, of cooking oil. Initially, they had this ban. They only allow you to export if you supply to the domestic market. So I don't know, maybe some didn't do it properly. So maybe they're just imposing this rule. And you cannot keep this ban for too long. There are a few reasons. Firstly, Indonesia collects almost $5 billion US from all the duties when they export. Then secondly, there's a lot of smallholders affected by this. I don't know, a couple of thousand, like maybe 40%, 30-40% of those punters are all smallholders. No, so this will also put pressure. And thirdly, a lot of countries are going to be affected. Like India imports a lot of palm oil. And this, you're not exporting like a watch or so forth, so you don't buy now. But this one is food. This is a food item. So we think that this ban on cooking palm oil, this ban on palm oil cannot last for too long. But once it's lifted, I think these share prices will jump back up. But in the meantime, I think there's going to be the weakness. I'm not sure how clear, but we seriously doubt this palm oil ban will last for too long. Because it's just too many reasons why it should be lifted. And we've seen it before, like the coal, eventually you'll be lifted. I hope that answers it. Natalie, you okay? You want to continue? Okay. Okay. Yep. I'll hand it over to you, Nathan.
Okay, sorry about that. My computer crashed. I'll just pick up from where I left off. I believe I was answering the question on, on the higher electricity costs on other REITs. Would higher electricity costs going forward negatively reduce the DPU of other REITs and data centers like Ascendus REIT and Mapletree Industrial Trust? How badly are they affected? So I don't exactly have the amount of sensitivity I don't exactly have the sensitivity analysis for the DPU. I'll share that with you guys in the coming weeks. Overall, higher electricity costs will affect all of the REITs, especially the REITs with assets in Singapore, because the even for the shopping malls and for the industrial properties, how they charge electricity costs is like they will pay for the electricity costs, and then they will charge a service cost to the tenants. And this service cost, obviously, if the electricity were to go up, I think some of the industrial assets and your office assets, they can actually raise the service charge correspondingly. But of course, the common areas and all usually is absorbed by the REIT. So therefore, when there is a higher electricity cost, the REIT will also get impacted. Another thing to note is that for retail malls, they also charge their tenants service charge. Due to the fair tenancy agreement, they are unable to adjust their charges, service charge during the period of the lease. So if let's say the lease it lasts for 3 years, that means during these 3 years you cannot adjust the service charge. Only at time of renewal, then the landlord can raise this service charge. Yeah, so of course, leases are expiring, throughout the year. So, there could be a chance that the service charges are being adjusted as the leases are renewed. Yeah. So, but in general, especially for Singapore properties, usually there will be a impact. For the overseas properties, I think most of them they are able to do it on a pass-through basis. Yeah. Sorry, next question. Let me just get it from here. Yes. Regarding KDC, is the DXC issue, is it a KDC or KDCR problem? Okay, so I think what happens is it is because this is a co-location asset. So either ways, the REIT will be impacted. Okay, so for Keppel DC, they have leases. The actual management of the data centers is being outsourced to one of the Keppel entities. So it's the Keppel DC REITs, Keppel DC Keppel Data Center entity that will be doing the co-location kind of management. And what Keppel DC receives from, so that means Keppel DC will lease. There'll be a middle party, which is Keppel Data Centers, and then the end tenant. So that means Keppel DC will collect from the Keppel Data Centers a fixed rate, as well as almost 99% of the cash EBITDA, and the tenants will pay Keppel Data Center. So either ways, right, because of the cash EBITDA portion, it will still be hit. Even if there's a litigation, it will be recorded on the Keppel Data Center side, and then it will flow through to Keppel DC REIT. So it will affect Keppel DC REIT. Secondly, sorry, I just look at the second half of the question is, secondly, the 14.8 million runs from 2021 to 2025. Is it about accounts receivable or contract dispute payment yet to be? So actually it's both, because the period actually starts last year, meaning to say that there's some partial non-payment that happened in 2021. So that means in this year they will start to recognize all of these they recognize the provisions for some of this service charge that has not been collected since 2021, and moving forward, meaning 2Q21 onwards, all the way until the end of the lease term, then that is when they will slowly apportion the the amount that is outstanding for the respective quarters. So of course, this is still under litigation. We don't know what's the outcome yet. Neither will KDC speculate on it. In the worst case scenario, what will happen is that they will just be unable to collect this $14.8 million for the service charge for the total 4 years. That's the worst case scenario. And a possible like good case scenario is if they are able to win the case, and then they can write back all of these accrued number one from 2021 kind of revenues, and also moving forward they will be able to collect the service revenue. Yeah. Another possible situation is if, let's say, both parties decide to terminate the agreement, which I think might not be so likely. Yeah. Okay. Yeah, I'll take the question about Tasin shortly. I'll pass the time back to the rest for now.
Okay, hello. I will take a few questions. So firstly on Nanofilm, is Nanofilm's PE of 30 times considered reasonable or expensive for a similar industry? If you compare to the other tech companies that are listed on the SGX, AEM PE is about 20 times, UMS is about 14 times. So if we just compare based on that, then Nanofilm's 30 times would be more expensive. But they do also emphasize that they are a deep tech company, which means that they are kind of like using these novel technologies, developing this new products based on this novel technologies. So interestingly, also the company, the market is also more willing to maybe pay more for this kind of new technologies. Yep. Next question is on how does the spin-off of LHN Logistics affect LHN shareholders? So I guess for LHN shareholders, or maybe a bit more picture on LHN company, before this spin-off, they have mainly the real estate or property management services and the logistics arm. So with the spin-off, I guess it will help to realize shareholder value, because before that they were a mix of having a bit of everything. They also have this facilities management where they operate car parks. So they will now be a company focused on property management services with the investment in logistics, and that would help with the valuations of the company. We value LHN at 7 times PE, and the indicative PE for LHN Logistics is 10.1 times, and LHN will continue to hold a 84.1% stake in the logistics arm. So that would help to actually push the valuations of the company up. And the last question on LHN Logistics is who is the placement agent and how to subscribe for the IPO? So the placement agent is Prime Partners and CGS CIMB. And thanks for your interest, but I think there is no public tranche for this IPO. So the motive of this IPO actually is mainly to kind of like restructure the company, realize shareholder value, instead of like purely raising funds. Yeah. I hope that helps. I guess that's all for me for now. I'll pass the time back to the rest of my colleagues.
Tim, you want to take some?
Yeah. There's a couple of questions on TDCX. So the first one is TDCX a consumer-focused business or commercial-focused business model? And how can they win their competitors' tanks? So for TDCX, the focus is their customers are tech companies. So I guess you can say they're commercial focus. And how can they win their competitors? So the biggest in this business, after we spoke to management, the competitive advantage in this business is very a lot of it is based on track record. So what TDCX does is that they have a track record with Google, Airbnb, and Facebook. And in this industry, trust is quite paramount, especially in the tech industry, because of due to the data sensitivity. Because what data is actually very important to tech companies. So if your clients are actually the big tech companies like Google, Airbnb, Facebook, then others are more, how you get advantage, competitive advantage is that your customers, new customers, are more comfortable in taking up your services if you already have clients like Google, Airbnb, and Facebook. So this is one of the big competitive advantage that TDCX has, and this is how they actually got up and running a few years back in 2016 when they got their first client, which is, I think it's Google. Then after a while, one by one, all the big tech companies just started using TDCX from then onwards. And just to give an example of how they are sensitive with data is that TDCX doesn't allow phones in their offices. They have a data server security setup whereby they ensure that all the data is still the clients like Facebook, Google, all the data is still theirs and TDCX has no access. So there's a lot of security when it comes to data, and I think because they have such a good track record, this is how they retain their competitive advantage in this market. Okay, the second question is who are TDCX top 2 clients that contribute 62% of revenue? The top 2 clients are Facebook and Airbnb. So they contribute 62%. The top 5 clients, we are not sure. They don't disclose. Sorry. Okay. And for the last US question, it would be about PayPal. So the PayPal question is, PayPal has decreased substantially by over 70%. Besides the geopolitical issue, what is the other cause of this steep decline? Thanks. We don't cover PayPal, but what we do cover is Amazon, which is in the e-commerce business, and PayPal has a lot of the business from PayPal is derived from online spending. So this is also in line with what they said, which is that inflation is impacting consumer spending in the US. So this caused them to cut their outlook, and also because of slower online spending as the economy reopens. So this is also causing PayPal to cut their guidance. So I think this is what is causing some headwinds for PayPal at the moment. But we don't cover the stock. It is just some color on what they may be facing. Okay, I think that's all for me. Pass back the time to my colleagues.
Now, okay, let me just run through some before I hand it back to Natalie. What is the theoretical value for Yang Zhejiang Financial Holdings when listing on this Thursday? We gave a range, I think the earliest slide. So if you think 0.6 times, you probably like 65 cents or even 0.7 times, maybe 75 cents. I think that could be likely the range, fair value range. Anything more, I'm not sure whether you should pay so much more. If you want China exposure, there's many other things. I know other ways to buy than buying it through Yang Zhejiang Financial Holdings. Yeah, okay. The next one, can I have your view on Lion OCBC HS Tank? Is Tank in China quite dead? Okay, we don't cover, but I'll just give you our macro thoughts now. Okay, the peak in this, I was looking at this, it peaked at 11,000, the index, the Hang Seng Tank Index, and now it's 4,000. So it's actually very similar to the dot-com bust. So at these levels, it kind of looks a bit safe because it's kind of de-risked. It's just like in 2000 when you had the dot-com bust, the downside is limited. Just not clear when this thing can recover because it's such a huge D-rating. And do note that a lot of the US investors won't be touching Chinese tech for quite some time, because I think after what has happened in Russia, I think a lot of the US investors are very mindful of investing in China because it is uninvestable in the sense that you can suddenly, in Russia, now any US investor you cannot sell, you cannot trade at all. It's like you're not even able to sell. So I'm just worried a lot of US investors will see this and just worry that can China become like a Russian situation where your stock, where you cannot sell, that means you're banned from selling the currency. So I'm not sure how this is, but there are longer term implications. But for the Hang Seng Tech, I think it looks quite interesting at these levels. I guess it's like almost like similar to dot-com bubble bursting. Sorry, yeah. Hope that helps. I'm not sure if it does. Silver Axis, should I take up the equal rights offer 33 cents each? What is your take? So sorry. For those who are not familiar, so what has happened is that Silverlake Axis is doing an equal access offer. So what it means is that they have a mandate to buy back shares. So instead of, most companies buy back shares every day, a bit here and a bit there, they just okay, I'll just give you once and for all, I'll just do a buyback across the board, 33 cents. Who wants to take it? Just give it to me. For my own personal view is I wouldn't take it up, because even the major shareholders are not taking it up. The major shareholders that own 60%. So it seems that 33 cents is almost like a line in the sand in terms of the what could be the almost fair value or undervaluation of this stock. It's also like a signal by the management that they think at these levels the share price is cheap, and this is a net cash company and they're willing to buy back. And I think they can even buy back more because they have a strong financial standing. And they are riding this huge wave because the last 2 years, banks haven't been spending on IT, and now you're beginning to see banks starting to spend. And if there's any more, especially like digital banking, and to compete against the digital banks, it will make them accelerate their spending even more. And who knows, maybe there's always M&A considerations. So like even when UOB buys something like the Citibank assets, there's also, and if UOB is their customer, there will also be like additional upfront projects for someone like Silverlake. So I think the landscape environment looks positive for them the next 2 years in terms of IT spending by the banks. Just that the last 2 years it was just frozen because of the pandemic. Okay, my last one before I hand it back to. I'll just take this last two before I hand it back to Natalie. Is Yang Zhejiang shipping now 93.5 cents now undervalued? In order to be a component of STI, is it necessary to be at least par value to be consideration? Okay, you don't need to be. There is no mention of par value, because if you look at Genting Singapore, like 80 cents, so Genting is also part of STI and it's not $1. In terms of whether Yang Zhejiang shipping is undervalued, it really depends on how you view the shipping cycle. I think looking outside, looking in, it does look like the shipping cycle is a bit extended. Everybody knows shipping rates has already kind of spiked up 5 times. So unless you expect shipping rates to climb further and the shipping ordering cycle to accelerate further, then I don't know, it may look like the shipping cycle might have already peaked. Again, this style of stocks usually is just based on order book momentum, and if the momentum is not there, we think the cycle might be a bit stretched. Yeah. Again, we don't cover, so I'm just giving you our thoughts. I'll just do one last one. I missed out in your first session of the webinar. Not sure if you have any advice whether to accept the cash payout for SPH shares or the cash plus SPH REIT. Just as a reminder, if you are a SPH shareholder, I think we talked about it in our last webinar, which is probably in YouTube. If you're an SPH shareholder, you will, by default, you don't have to choose anything. You will get the cash and the SPH REIT shares. So we did a calculation. We think the cash offer is probably 2 cents better. The $2.33 cash offer is better than the shares and the REIT, because the REIT, there is a takeover, there is a price has already been confirmed. So if you take that price and you take the cash offer, it's like probably 2 cents or 3 cents lower than the cash offer. Yeah, but if you want to hear the recording, you can go to YouTube. I think we discussed it. Just I can't recall all the details. Yeah. But I remember that the cash offer is better than the cash and SPH REIT offer. Okay, and Natalie, you want to take some, or you?
Okay, I'll take the question of Tassin. Can you share on Tassin Retail Trust with regard to its refinancing with the banks and their proposed divestments to be used in paying off their debt? Also, any idea on what their latest debt level is? Okay, so first of all, the debt level, the amount that will be outstanding is 742 million. So that is about 78% of the total loans that they have. Yeah, so the total loans is about 950 million Singapore dollars. Yeah. Okay. Basically, 500 million was already you know, it was already up for refinancing, and it was, instead of refinance, it was extended on 3 months basis for like 2 times. And then this year there's also additional loans that's expiring, so it's sort of snowballed from 500 million to 740 million. Yeah, and that is 78% of the total loans. Okay, so there's actually no real update yet on what is the refinancing status. The REIT has not yet have anything to update us. I think the last thing that they said was they're trying to get a refinancing, but of course there are some, because it's a syndicated loan, some parties of the syndicated loan, they have additional requirements. They want to add on additional, I don't know, covenants or terms when they offer this refinancing. So that of course delays the process, because as a syndicated loan, all parties must agree. Yeah. So of course they also entered into a non-binding MOU to divest 2 of their malls, which is Siqi and Xiaolan. Yeah. And there's no conclusion yet, and it's not confirmed, but that is one of the ways in which they can lower the debt. Yeah. I also saw you know, in their AGM responses to AGM questions, I think it was said that there might be a 20% haircut for these 2 malls that are being offered. So I think of course if the sale does go through, I think it will still be subject to independent valuations, etc. So even with regard to the 20% haircut, I think it's also not confirmed. Yeah, so everything is a bit up in the air with regard to Dasin. Okay. Okay, so there's a question here with regard to KDC's investment in M1 bonds. So I think that was actually announced last year. Give me a second to pull it up. I think the yield for this bond is about 7%. Yeah, so it's actually quite good. I mean, it's not considered data center, but it is a good investment, just based on the very high yield from these bonds. Yeah, and this bonds is actually for M1's netco assets. So the M1, they actually divested some of their network assets into a SPV, and the SPV issued these bonds to Keppel DC. Yeah. Okay. Okay, sorry. I'll come back to you about with regard to the Mapletree and Digital Core.
Okay, thanks. Let me just run through some. Hi, Paul, what are your views on the selection of the new 4G leaders in terms of the impact on the markets? Okay, obviously it's very sensitive, but I'll just elaborate from the point of view of a foreign investor. I guess from foreign investor point of view, so long as there's succession and there's no like big change in the party and policies continue, so long as there's political stability, I think it will be a positive. Again, this is not a political comment, it's just as a foreign investor. And more importantly, I think if you're a high net worth individual, when you park money in Singapore, again, the same thing applies. As long as there's succession, there's no real change in policies. Not like you're suddenly going to tax anyone who parks money there. I think so long as the policies remain the same and stability, then I think it will be it should be a positive. I think I guess if you're a private banker talking to your clients, and then that's probably the answer you give to. Yeah. Again, I'm not sure how helpful that was. Yeah. Can you elaborate on the KDCR investment in M1 bonds? Yeah, sorry, I think this one I don't have the details. I think we need to wait for Terence, because Terence covers Keppel. Just that he's away. Yeah, then we'll probably, if you can pose it to him or email him, then he will probably help you on that. Yeah. With Yang Zhejiang Financial Holdings added to STI, does it mean that STI will have 31 constituents? And it is stated that Yang Zhejiang will have same investable weight as Yang Zhejiang. may I know where can I find information on the current investable weight? Okay, if you want to get the components, the STI index components, you're either a subscriber or you just go Google and you type ETF. You just type, because the ETFs will give you because ETFs will disclose the STI ETF. I think it's SPDR. I think the one that I've usually looked at. If you go Google and search, normally the ETFs will every day give you the holdings, even in Excel form. I think the one that I usually refer to, since I don't have to go and subscribe, is the SPDR Straits Times Index. If you go to their website, the State Street ETF, they will give you a daily index. Yeah, okay, whether you have 31 constituents, yeah, I guess that's why someone has to be removed. So it's either Yang Zhejiang Financial Holdings or Yang Zhejiang or Comfort Delgro. Yeah, I'm not sure. Actually, that's the curious thing. I'm not sure if because if you do by market cap, Yang Zhejiang Ship Holding is actually the smaller one. Yeah. So I think this time we're definitely going to ask management just to get some clarity on it. But yeah. What's the likelihood of Comfort Delgro to stay in STI come 5th May? Your views? I think in the near term, this very near term up to 5th, there's virtually no upside, right, for Comfort if you think about it. So even if Comfort Delgro remains, nothing. The share price didn't drop today because of that. So I think there's like very, very short term Comfort Delgro, there's virtually no upside, because even if they say they remain, I don't think people are just going to buy because the index was already there. But there is downside in the sense that if they are removed, the passive money or even some funds that like to hug the index might have to sell it out. So I think in a very short term, there's more downside for Comfort Delgro because of this STI thing. It's very difficult to gauge the amount because we do not know how much is the pool of passive money out there. But I think logically, yeah. Or will it be the Yang Zhejiang Financial Holdings? Yeah, again, it depends on the market cap, whether Yang Zhejiang Financial Holdings has a higher market cap, and the price to watch is I think 80 cents. Anything higher than 80 cents means Yang Zhejiang Financial Holdings would be removed. So what it means is that then you might have added selling pressure. That means those passive funds, the ETFs that got Yang Zhejiang Financial Holdings, is no longer part of the index, right? So I'm just going to sell it. So it's very tricky on this part. Yeah. So how the price closes will be quite critical. Again, this is all our own conclusion. It's not like the FTSE gave us any briefing. This is all our own analysis and reading from the documents. When will Yang Zhejiang shareholders get their shares? I think it should be by the 27th, I think. I'm looking at the timeline earlier. Should be on the 27th that 27 will be April will be the distribution date. Singapore ONG failed on their privatization and extended it till early May. What's the likelihood of them succeeding then? Not sure for that. I think there's a good chance because if I'm not mistaken, they collected up to 89%, so there could be just 1 more percent. So I think there's a good chance. And I think worst case, if they cannot, they might not just nudge the offer up again because they didn't say the offer was final. It's only when they say final offer, then they may not be able to raise because the authorities take it very seriously, like we highlighted before. You cannot say final, then you say, oh no, it's not final. Once you say final price means you cannot change. So I think, or you might just play around with it, maybe give issue shares or something. But I think they could have a good chance of privatizing because they already had like 89, if I'm not mistaken, the last time I checked. Okay, may I know if the percentage weight of STI components actually fluctuate every day? Yes, they do fluctuate by the market cap, yes. Or the weightage is fixed throughout the quarter and change only after. The weighting will change. Yeah, it's like you hold any stock. Let's say you have a portfolio of 10 stocks. You will just move around, and they will only rebalance that is to take out or put in any one quarterly. Yeah. what is the price range that will kick ComfortDelGro from STI? How could it happen and impact Comfort? Like we highlighted, the price range is probably Yang Financial, maybe above 80 cents. Yeah, our own estimate for and yeah, I mean, when the passive money or even some funds might sell it, but it's usually the passive money which is like the ETFs. Yeah. Again, it's very hard to compute we never had a database of, I mean, until we do it, I mean, have a database of all the passive money. I think you can do it, but I mean, there's the pool of passive money that holds the STI. That one we don't have the data, so we can't calculate like what would be like. Let's say there's a 5 million or 10 million, like how many days for them, or like what's the impact. But also do remember, do take note that not being on the STI is not end of the world. Like SPH got kicked out of the STI, and actually the share price, as we all know, it got privatized. Even Hutchison Port, when he got kicked out of the STI, then after the initial sell down, the share price just rallied. So it doesn't mean out the STI means it's like doom and gloom, but it actually might be, in a way, ironically, it has been a positive for some of these stocks like SPH and Hutchison Port by being kicked out of the STI. What's the chance of the both? What's the chance of both Yang and Financial Holdings being removed from after 5th May? Does FTT stand a good chance? Actually, that's a good point. I don't want to really not clear, because I'm not sure how the FTSE views this. But in terms of the reserve list, that means those stocks that are eligible, the largest is by ranking, FCT will be the top of the rank. So again, that's also a possibility. It's not clear to us, because all this only happen because now but Dairy Farm remains the smallest of all. So it could be Dairy Farm that gets kicked out and then FCT comes in. Again, it's a bit opaque, not like FTSE tells everybody. So there's a bit of opaqueness, what is behind FTSE's thoughts. But if you look at the table earlier that we showed you, the smallest index component is actually 0.4 times actually Dairy Farm. Yang, the shipbuilding, is actually 0.6%, I think. Yeah. So the most likely will be Dairy Farm than Yang shipbuilding. Okay. Okay. Let me just take this last three and then hand it back to everyone. Since residential sale is down, do you think the outlook of developers are not good for maybe 1 year or more? Yeah. My view is just that the volume may not be good, but the margins could be much better, I think, because the prices could continue to climb or at least stabilize, because there's just no inventory out there. There's virtually only 1.5 years of inventory. So that was what we were rationalizing. Yeah, and like CDL already sold, so they got revenue to recognize, and they also have inventory, which is, I guess, in this cycle right now, could be valuable right now, because there's just not enough units to be sold, which is very strange. I mean, a lot of the developers, when we speak to them, they're all sidelined because they want to see how the market responds before they come in. Yeah, because once you bid a land, your clock is ticking. You got maybe, I don't know, 2 years or 2.5 years to launch, sell, and get it all done. So a lot of them are waiting on the sidelines. Sorry, don't quite understand the slide which has Freedom Day and why SIA has 2 lines with different prices. Okay, on that slide, what we were just trying to show is the okay, because when you want to buy a reopening stock, you want to see how was the share price. You don't want to buy a stock where pre-pandemic was maybe $1, then now it's already 110. Then what's the point? It's already priced in the pre-pandemic. So that slide was just to show whether some of these reopening stocks, have they priced in the reopening. So which date is it? Can you go back to the slide? So which date is it? Depends on it can be, you want to depend when you want to decide. It could be March or whatever. But our point, one more back again. Sorry. Yeah. Okay. So if you, let's take a Kimley. So if you're buying Kimley for reopening, you forget it because it's already above the reopening. So that was our point. We just want to show that if you're trying to play a reopening, you also have to be careful. You shouldn't be buying a stock where already priced in a lot of reopening. Yeah. So like if you take SIA Engineering, it's already kind of priced in a lot of the reopening that that things are back to the norm, no? Back to norm. Unless you think it can grow much faster than the pre-pandemic, then you should pay more for it. So that's the whole purpose of this chart. For SIA, why you see this weird thing is because what we are doing is that we are so SIA number of shares right now is about 3 billion, I think, roughly. Correct me if I'm wrong, but so 3 billion shares, but if you take into account the MCB, the shares might double to, I think, 7 billion, if somewhere around there. So that's why you get $12. So it's like we doubled, so the number of shares has increased. So we're just assuming the market cap has doubled. So that's why we get this $12. Like we highlighted many times before, again, some who may not understand, the MCBs is not part of the market cap. So it's not part of shares, but it is part of NAV. So the $5 is excluding the MCBs, which is another 3 billion shares, which SIA say, oh, they're not, it's not part of the market cap, which unless SIA wants to pay back, I think this 9 billion or 8 billion of debt. So if you include those shares, that's why you see the 12 cents. Yeah, it's a bit confusing. Yeah, but because this product has done so well, don't be surprised if they use it for other restructurings. If they want to do even if they want to do like a Keppel or restructuring, whatever, this is quite a useful instrument for Temasek to issue MCBs. Oh, okay. I think I hand it over to. Let me do a last one. High point in your reopening team, MM2 and Unusual seem to have better recovery percentage upside. Is that your view? Okay, this is not my view. This is basically what we're trying to tell you, like we highlighted. If you think things go back to the norm, that means if revenue, let's say cinema all go back to pre-pandemic, then this could possibly be the upside. Okay, this could be the potential upside. If things go back, like if concerts come back for Unusual back to the pre-pandemic, then earnings go back, then this should be the upside. Yeah, it doesn't mean depending on balance sheet or whatever, but this is just the general. This is what we're trying to say. Yeah, I hope not to confuse everyone. Yeah, thanks. Natalie, you want to take over?
I'll take the question on, are you able to quantify the negative impact to DPU for Digital Core and Mapletree Industrial due to SunGard ES filing for bankruptcy protection in the US and Canada? Number two, why does the share price of Digital Core drop 5.6%, lesser than the 1% share price drop of Mapletree MIT since 21st April closing price? Is this an opportunity to buy Digital Core REIT? So for Digital Core REIT, I believe the impact to revenue is about 7.1%, 7.1%. Whereas for Digital Core, I think it's about 1.3% to DPU. Yeah, because of initially, yeah, basically it was a larger percent of the data center portfolio they acquired, but due to the totality of the impact is actually smaller. Yeah. Why did the share price drop 5.6% lesser than the 1% share price drop in MIT? Since 21st April. Yeah, so I believe you are saying that the share price of Digital Core dropped larger, right, than the share price of MIT. Yeah, I think partly because probably for the Digital Core, they actually the impact to this SunGard is higher than for Mapletree Industrial Trust. Another thing I just want to point out is that apart from the rising energy costs, for Digital Core REIT, right, their cost of borrowings of 1.1% which they announced at time of IPO, actually a large portion of it is actually floating loans. So that means to say, as the Fed rises the rates and as the short-term rates rise, there could be actually a larger impact to digital core. Yeah. So that's just one thing that I would like to point out with regard to digital core. Okay, I think that's about it for me.
Okay. Sorry, I think just to avoid some confusion again, let me just elaborate one more time what this chart actually means. So let's say Genting Singapore. Yeah, sorry everyone, just bear with it. Okay. Let's say everybody wants to play Genting Singapore. Okay, because it's a reopening. Tourists will come back. Then you will want to know like what is the fair value rather than do all the PE. Don't have to make it so hard. So what we're trying to say is that before the whole pandemic occurred, Genting Singapore was worth 92 cents. So it should trade back to the 92 if things resume to norm. If you want to trade it a bit more, means you think that it could actually recover stronger than pre-pandemic. That's as simple as that. That was why we do this whole chart here. So you don't actually have to go and do calculations, don't do PE on that. As long as you think it goes back to norm, then it should be worth at least 92 cents. Yeah. Okay. I think we've answered all the questions. So thanks everyone for your time. There will be no session the following week because of the Ramadan or Hari Raya. So we will do it in 2 weeks' time. And thanks everyone for your questions and for your time. And just like to wish all our Muslim friends a good Hari Raya celebration. Thank you everybody. Thanks again for your participation.